In this video, I'll show how to do cash covered put option selling. So first of all, what's a put option? The buyer of a put option retains the right to sell a stock to the put option seller at a particular strike price, even if the stock price went below the strike price. The buyer of a put option basically buys protection for the stock position when he buys a put option for which he pays a premium to the seller. Sounds like insurance, isn't it? Well, it is. The seller acts like the insurance company where he gauges the risk of selling the put contract since he could get the stock assigned to him even if the price went way below the strike price paid for the option. One contract covers 100 shares in USA typically. Some non-standard ones are present as well, but we are talking about standard options in Chicago Board of Options Trade. And a put option comes with a particular strike price and an expiry date. Put options get more expensive as expiry date gets longer, since the put writer has to consider the risk of covering the position for that much time, where there is a higher chance of a stock going lower, thus more risk. Selling short-term puts is considered as an income generation strategy when done right. Now, what is a cash covered put? A cash covered put option, or more commonly called as a cash secured put or CSP, is an options trading strategy where you sell or write a put option while simultaneously setting aside enough cash in your account to buy the underlying stock if the stock option gets excised by the buyer or the assignment happens to the seller. It's generally considered a conservative income generating strategy, often employed by investors who are willing to buy a specific stock but only at a lower predetermined price. Of course, in some cases, the investors may close the position well below the expiry date, just take the income generated and either they roll it to the next expiry date or they move on to some other stock. So it need not be always from the purpose of buying a stock at a lower price. Okay. Now, how to select a stock to sell cash covered put? A put writer has to assume that the stock on which he sells put could be assigned to him on a market downturn in case the stock is trading below the strike price of the put option. So he should think like an investor who wants to buy the stock really, because the stock could be assigned to him. The stock must be bullish when looked from a 200-day moving average and a 50-day moving average perspectives. Trend lines on price chart should show positive slope. Stock should have just reported earnings and stock should be up after earnings report. That's like the market say giving a thumbs up for the earnings. Okay, that's an additional insurance for a put seller that things are okay with the stock and market likes it. Okay, so just to tell you my strategy, I will never sell puts aimed at producing income before earnings, however confident I am, as the earnings can always surprise on either side. As you all know, the earnings get reported every quarter, 3 times in a year for quarterly reports and 1 time for the annual report. Average analyst price targets are way above where the stock is trading for the stock for which you want to sell puts. That's like a margin of safety for you. Okay, so at least look for 10% at a minimum where the stock price is below the analyst recommended target prices. Average, let's say a stock is covered by 10 analysts, they all are going to have different stock price targets. But when you average the prices out, you will get a particular number, and make sure the current price at which the stock is trading is well below that target price number. Along with you making sure the other criteria that the stock is bullish and it has had a good earnings call, and the market liked the stock after the earnings by making sure that the stock was taken above the previous day. Okay, so I will show you with an example soon. Another point is stock must have good fundamentals, basically a good balance sheet with low debt and good earnings growth, etc. For people who are not familiar with balance sheet and things like that, I hope to put another video where I can educate as to how to read financial statements, and basically it is about lifting under the hood and looking at, things are looking fine with the stock. Okay, and finally, do not sell puts on low quality stocks. By low quality, what I mean, do not try to sell puts on stocks with a lot of debt. The earnings are going down, the revenues are going down. In such stocks will give a lot of premium, but do not fall for the premium, because your stock depreciation will be more than the premium you get. Sometimes you can get into immense losses, especially if you get assigned on a low quality stock and the stock keeps on going down. You could have a huge capital loss. Okay, stay with quality. Do not get avaricious when it comes to gaining premium. All right. Now, we were studying whether Google will fit the bill if you want to sell puts on it recently. That's the case I want to explain. So basically, Google reported earnings after market close on the day of October the 29th. That is the bottommost row here. On that day, the stock had opened at $267.75 and it closed at $274.57. Okay, and the market closed after which the Google released the earnings, and we noticed after market response was pretty good, and the next day the stock opened gapping up. You can see it nearly gapped up $16, more than $17. Okay, and then it kind of closed lower somewhat, but still well above the previous day's closing price at $281.48. So this was the very first check. Okay, the earnings was received very well by the market. Also notice the volume. You can see the previous day it was 43 million, and on the day when the stock, next day there were more investors coming in buying it. So if you did an on-balance volume, this must have been a plus 74 or 75 million shares, right? So this was a good thumbs up also. Okay. Now, case of Alphabet on November 4th. Basically, we saw that, hey, Google went up, they had a great earnings call, but you don't jump in and sell the put right away. You wait for a pullback day. So we are checking the October 30th was great, okay, fine. And on October 31st, the stock went up even more. It had, the opening was really good, but it did close at the same price. And now, and the next day was November 3rd, and you see that the stock closed well above the 281 close price of the previous trading day. So the stock is basically gaining bullishness. This is all great, when you want to sell puts, but at the same time you are, kind of thinking, maybe it's going to run away from him. Never get impatient. You will always get a pullback, and then you can pull the trigger. Yeah, that day happened on the November 4th. November 4th, it gapped down for no reason. 283 it closed on the previous day, and on November 4th it was 276. I believe it was some concern with the AI stocks or whatever. So along with the general market, Google also was pulled down because this is also an AI stock, so maybe that was one of the reasons. But if you are confident on the fundamentals of it, it all depends on your analysis and how much you are confident on it. In my case, I was pretty confident on Google. I saw the earnings report, I listened to the conference call, everything looked great, and I wanted to get in back on the stock because I've been trading in and out of Google, and but before the earnings I had closed my positions, and then I wanted to re-enter, but I wanted to get on a good lower price. So you see, before earnings, we closed on 274. On the day of November 4th, it almost came to that price. Okay, so this is good day for me to open my put position again. So on this day, I don't know, at some part of the day, I would have chosen to sell the put based on the technicals, intraday technicals. I will just briefly go over that. So November 4th was on the day we wanted to sell the put. Okay, because it had pulled back. So that's the thing. On the next slide we are explaining case of Alphabet on November 4th. Explore if Alphabet stock could be the candidate to sell puts on. As I told, check if the stock is bullish from moving average perspectives. Yes. Stock price chart showing positive trend. Yes. Did stock report earnings already just before few days? Yes. That's one thing. You don't want to go too far after the earnings was reported, because this is when the volatility will be very high. You will get a higher IV on the stock, and you can actually start to play that. Okay. And next, did your stock go up post earnings? Yes. Did it have a temporary pullback intraday? Yes. Analyst target above where it is trading? Yes. Average analyst price target for Google is $314.18. Okay. And on November 4th, trading range was 276 through 281, well below the analyst price targets. Okay. So we chose $300 strike price to have a margin of safety with roughly 50 days towards expiry. So the expiry date chosen was December 19, 2025 for these option contract sales. So such period helps the decay of option delta faster. If you want to sell option for income, you try to keep it around 40 to 50 days, and your option decay you'll find that it is in your favor, because when you are a seller, you want the option to decay faster, option premium to decay faster. I will show you what happened 2 days later after we sold this option. Okay, so this is what happened. This was the day the earnings came up, and the next day it went up, but then on November 4th we saw the pullback on which we sold this, right? So how we did that? November 4th we saw that it gapped down, so this was a day we wanted to do it, but then you don't want to do it right at the open. You want to kind of wait, if there, in case if the market takes it down further, so you want to wait for some time, like use a 15-minute RSI or something like that, and wait on it. When when the things recover from the point, from the intraday low, you may not catch the exact low, but it's okay. You don't have to do the exact, but as long as you don't buy near the day high, it's fine. So you want to see the intraday chart trend low, go below the RSI, the relative strength index, reaching a near 30-40 level, and then when it is recovering back from there, you want to place your bet. Okay, that's when you pull the trigger. Okay, some people use MACD in combination with RSI. It's okay. I also sometimes look at it. As long as I get a decent price, okay, I kind of go with it. So I want to buy somewhere near the intraday low. I don't think I caught the intraday low. I was more like somewhere between the close price and maybe somewhere around 277. I managed to pull the trigger. So and let's see how much premium we got. Okay, so this was a transaction we got for the 300-day, $300. We got $25 premium. So the stock was around 277. 277 plus 25 will take you actually to 302, but you got a $2, time premium. That's what it means. Time premium for 50 days was $2. And this is for the $25 was the premium that was received in this, right? So $23 was actually in the money here, because these are called so-called in the money, because as of after the user bought it, he has the right to assign it to you. Of course, he will be crazy to do that because he will lose all this premium. You could as well have bought, sold the stock, directly in the market, not buy a put option to protect his position and then sell it and lose all the premium. Okay, so at least he would have lost the $2 time premium, correct? Right. So now let's see how this develops. This was the selling transaction. We got $25 premium for 50 days for a $300 strike price. This is in the money put. Remember, the stock is trading at 277. So when you do this, what are you thinking? The stock will gain towards 300. Maybe it will go to 300 and beyond, or it may be at least 290. So with the time premium and 290, you will gain close to $15. That's what you are thinking. Okay, or if by December 19th, if the stock crossed 300, let's say it's trading at 305, you get to keep all the premium that you received. Okay, so we are still not there yet, in the sense December 19th is still a little far away, but today, as I am making this video, it is November 6th, and we are looking at of course, this is about the sale of the premium, sale of the put. Average analyst price target of 314, chose $300 price target, as I explained, and this was the option symbol we sold, and two contracts mapped to 200 shares at $300 per share. The cash deposit is $60,000 to cover the assignment in case it happens, because you don't get to sell a cash covered put without depositing the underlying need in case the stock has to be assigned to you. Okay, so that's why for 200 shares you have to put $60,000 as the deposit with the broker. Okay, now premium received 25 per share, or for 200 it will be 5,000 for the contracts, two contracts, and that minus 0.65 per contract. So the net received is $4,998.66 as the premium in your account that was credited. The above put sell transaction was performed on an account of a family friend, which I help manage. Okay, and now let's review what happened to this November 6th. On November 6th, right? So on November 6th, we are looking at the position in the account. You can see I am short by 2 because we sold these two puts. That's why it's -2. And then the last it traded at $20.13. If you remember how much we bought it for, we had bought it for, we sold it for, we sold for $25 per share premium, but during the intraday high, this had gone down as much as $20.13. Actually, when it closed, it was about quoting $21.35 per share at the bid, and then 21.55 at the ask. That means at midpoint it will be 21.45, but you sold at 25. Even assuming you have to pay the ask price to close, assuming you did a hypothetical close at this close price, you would have a gain of $688.66 on this position. This was done just 2 days before, and the gain is $688.66. So if you assume from my friend's account, we deposited $60,000 for opening this position, but it gained $688.66 in 2 days. Okay, and that is more than 1.1%, right? More than 1.1%. in about 2 days. Think of the annual return. Of course, this position is only for 50 days, and we don't know how the stock will develop further. But if it goes above 300, as of December 19th, my friend's account would be gaining 8.33% of return on that $60,000 he parked for this, right? Because $4,998 or 66 cents over 60,000 multiplied by 100% will be 8.33% return. And that return is within 45 days. You can annualize it. Okay? That'll be a lot. The idea is now this money is free to reinvest after the December 19th. Then you go ahead and put it in a new premium, put premium that you sell. So basically that's the idea of income generation. Okay, assuming the stock doesn't get assigned, that will be the ideal case, but in some cases the stock will get assigned, especially in the case of in the money puts. But a lot of times you will be able to roll it without the assignment. You can buy back the put at much cheaper. Maybe you can buy back this put 1 month into the position, maybe end of November we may be able to buy it back at $10. Okay, so you will gain $15 a share, and that for 200 times 15 is $3,000. So $3,000 would be 5% return in about a month. Take it to the bank, right? So hopefully you understood the technique, okay, how we do this. And usual disclaimers: options involve risk of losing capital. The information provided is for educative purpose only. Everyone must trade at own risk. Okay, with that said, good luck with your trading. If you like this video, put a like and subscribe to my channel. So that will encourage me to put more of my learnings. That will help you also. Thank you.